Hey, this is Sasha Evdokov, and thanks for joining me here for another educational training video about options. Now today what I'd like to do is go in detail about selling a call option. Now for many people, they don't understand that you can actually sell options without having the stock or without owning the other option side of the trade. In fact, selling call options or selling options in general is more popular amongst professionals than buying option contracts. And that is because you can allow the time value or the time decay to work in your favor. So in either case, understand that there's four parts to a trade. You can buy a call, you can sell a call, you can buy a put, you can sell a put. So in our case and situation, in this video, we're going to talk about selling a call option. Now, selling a call option is very similar to selling a car that is not on a lot. Dealers or car dealerships, they often sell cars that aren't even on the lot because you might want it in a different color, you might want different seats, different color seats, different little details and bonuses, add-ons, and special features that they may not have on the lot. So what they typically do is the car, they sell it to you, it's already sold, but they order it, make it for you. And that's ultimately what happens with selling call options. So let's take a look at in more detail about selling a call option, look at some profit pictures and risk profiles, and then also look on screen how we can execute that trade and order. So first off, what is a call option? Well, typically most people, they're buying calls, at least the beginner people. When you buy a call, it means you're looking for the stock to go up. You have a bullish outlook, okay? That's an upward direction. When you're selling a call, it means you're looking for the stock to go down. It's a bearish outlook. Now, typically, many people, the way they approach selling calls is they already have a stock position, and then what they do is they sell upside calls, also known as a covered call strategy, against it. Now, I'll show you this briefly, but I'm going to do another video that's in more detail that'll show you this exact strategy. But in the meantime, let's just talk about selling a call option. And in this case, we're going to talk about basically this would be a naked position because you're going to have unlimited risk. And you'll see what I'm talking about here in a second. Now, here's a quick cheat sheet for you as far as looking at what happens when you're a buyer of a call. You want stock prices to go up. When you're a buyer of a put, you want stock prices to go down. If you're a seller of a call, you actually want prices to go down for that call. If you're a seller of a put, you actually want stock prices to go up. So that's a little cheat sheet for you if you're having a hard time to remember where you want the direction of the price to go for a stock when you are a buyer or seller of a call or a put. So taking a look at our risk profile picture, here it is when we talk about selling a call. Now, the biggest issue or problem that we have here is the unlimited loss potential that we can get if that stock price continues to head higher. So the way that you really read these risk profiles is, again, you have the profit here on the left and the loss. And here is our zero line. So anything above that zero line is a profit. Anything below that is a loss. Our stock price is towards the bottom. So as the stock price goes up, we lose money. And we can actually lose an unlimited amount based on this. So the black line is our call contract at expiration. And this pink line continues to get closer to our black line with time. Okay, so over time it gets closer and closer. And what happens here is we make money day in and day out as that stock basically does not move or it moves to the downside. Okay, so selling a call is actually kind of like buying a put, as you can see. However, the difference is you have a capped or max profit. You can't make any more than that. Basically, if you sell a pair of shoes for $75, that is basically pretty much all you can get. You can't get more in the future. You're just making $75. All you can do is maybe lower your purchase price. So in our case and situation here, that is what's happening is when we sell a call, we're looking for a downside move, not an upside move. And ultimately with time, that line the current line today, let's say we started right here at 50, it continues to get closer and closer to expiration, and that's what we would make on the profitability side. If it moves downward, then we can make, if it's at the $35 level, we can make our full max profit potential. Anyways, that gives you a little bit of insight to a risk profile picture of selling a call. Let's take a look at how to sell a call on an option trading platform, because that's a little bit more direct to what you'll be looking at. So the first thing I want to do is show you, let's just take McDonald's for example. Just want to show you what buying a put looks like on a risk profile picture. So here I'll right click, buy a put, analyze the picture, and you can see here I have a downside move. I need this stock or this option really to move to the downside. So here's our price level, right? Here's our zero line, and you can see that there's my current price at the 154. I want that stock to move down because that's when I make more money, right? And as I move my mouse, you can see there's my profit, and if I move it down, there's kind of my loss. And what I can also do is move this to 150, which is a little bit closer. I can move it to even 155, which gives me a little bit more acceleration there on the profit potential. So that way, if it goes to 145, I make $650. The problem with this is if you're buying a put, right? So take a look at buying a put. If this stock stands still, I'm losing $3.18 every single time. And with time continuing to move forward, you can see the losses here continue to add up, right? So as I continue to move the time and date forward, I continue to lose more and more money. And basically, I need this stock to move. If it stands still, I lose money because I'm below that zero line. Okay, I basically need it to move above that price point of about 151, right? If it goes down, or actually if it goes to the upside, I lose money. If it stands still, I lose money. The only way I make money is if it goes down, and it has to go down in a pretty big way, about 4 or 5 points here on this stock. Now, with a call option, what's different here is if I go ahead and let's just say I sell this 160 call option, and we'll just do a single. Again, take a look. I'm taking kind of the opposite side of the call, or the call trade, right? So buying a call would be this way. Okay, so I'm looking for unlimited profit potential here with buying a call, right? So this person who buys the call is looking for unlimited profit potential. Now for me, if I'm a seller of this call, I'm actually looking for the other side of the trade, right? So I'm looking for this side. Let's see if we can do an orange color. So right there, I'm actually looking on this side of the call, or the opposite side of the trade. So if I flip this, you'll notice how that angle will just go down, that arm, right? So I'll flip it, and you can see, boom, right there. So now I have unlimited loss right there to the upside. So if the stock price continues to head higher, I'm losing money, right? So you can see I'm losing 400, 1,000. If that stock gets to, let's say, $200, by tomorrow, I'm losing $3,000, $4,000. So ultimately, that's what's happening in selling a call, because you are naked. You're selling a naked call. Okay. Now here, the difference though, the advantages that you have is you basically make a positive theta. So every day that white line gets closer to the green line. So you're making $2.50 time and time again. Okay. And your max profit potential is right there, right around 150. Okay. And you can see that because that's what you sell it for. So that's the most you can make. That's the amount. Now, if you get into, let's say this stock drops to 142 in 2-3 days, you're at a very safe point, right? If it drops to 142, you're at 140 on the white line, which is the today line. And then the rest, you just wait until time expires to make your extra $10. Can you get out of it early? Absolutely. You can get out of any option contracts early. But if you want, you could just let these things expire if you're in a sweet zone, okay, or a nice spot, because that's the green line is your expiration line. So anyways, you can see the advantage of selling a call, because what happens is if a stock stands still, you make money, right? So if it's right here, if it goes down, I make money. And if it goes up a little bit, I still make money and make my max profit up to 160, but I still make some money up to 161, 162. So you can see how the probability of success increases with this. Unfortunately, you don't have that unlimited upside money potential, right? So in this case, you could make $2,000, $3,000 if that stock explodes to 186. Now, the chance of that happening is unlikely, but you do have an unlimited potential and a capped max loss of 163. Whereas if you sell the call, you have an unlimited loss potential, which is naked, and you need to have an advanced option level and capability to be able to do this. Now, for most people, they sell these call contracts because they own, let's say, 100 shares of McDonald's stock. So for example, if I had 100 shares of McDonald's stock, I could go ahead and sell a call contract, against it. And what this allows me to do is think of it like two trades, right? The McDonald's stock, I make money from it from going up. The call contract, I make money from it from staying under that 160. So if this McDonald's stock doesn't do anything and stand still, normally I don't make any money. But because I have that call contract from selling it, right, what it allows me to do is make that additional $150, okay, from just pretty much sitting still. And if it continues to go up, I make my appreciation from my stock, but I lose a little bit of money from that option contract, especially as it continues to head higher. Now the difference is because I have 100 shares of stock, if it goes beyond it, what they'll do is they'll take away my 100 shares of stock. And that's ultimately the dangers, whereas if you sell this without stock, you're continuing to go into a bigger and bigger loss because you owe the stock at that $160 price point, okay? That's if you didn't own the stock, that's where you have the problems. But when you own the stock, well, they would just take your stock away at 160. So if it's at 164, they take it away. You still get to keep that $150 and you get to sell your stock at 160. But if you want that stock and you want it back, you'll have to buy it back at 164. So that's kind of the downside, but we'll get more in detail into covered calls in another video. For now, just understand and recognize that when you sell a call contract, when you're selling a call, you're looking for prices to actually go down, or you need it to stay below a certain point. Selling calls is a downward direction bias. That's what you're looking for. You're technically bearish on the position, or you're neutral. If you want it to just stand still and hang out right there below a certain price level, then this is the position to put on. Now you could do it a little bit closer. Let's say you were at 155. In that case, you'll make more money, but you pretty much have that break even at that 158 and your max at 155. If you go wider, right? If I go to 160, I make less. I make $150. That's my $1.50. But I'm safer, meaning I have a bigger range or a wider range. If I go 165, I can go even wider. Now, I only make $51 on this one, but my chance of success is a lot higher. So anyways, you have to play with those probabilities based on your own personal situation and risk levels, but that's ultimately what you're looking at with a call contract. So thanks for joining me in today's video about discussing selling a call contract. Hope you got some more insights about option trading in this video. Now, if you want to see the in-depth training courses that I have available on option trading, visit my website at tradersfly.com, and there's a courses section that you can go and read and learn more about those in-depth premium video course series that I have, all focused on options. Now, if you want to do a Q&A or join me on a live webinar class, or just see some of the stocks that I'm watching, go ahead and get on my newsletter list by clicking the button right here. When you get there, enter your name and email address, and you'll get those newsletters sent to you as they are released. And that way you can be in the know when new things are happening, new courses, new material, and when I have those live webinar classes. Thanks again, and in the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.